Well, the Shanghai index fell 6% yesterday and has added another 2.5% to that today, which infected other Asian markets such as Japan and followed on from relatively smaller falls in New York and Europe last night. But it's too early for Chinese investors to man the lifeboats or for the government there to get out the megaphone and tell investors to stop selling as they did in June and July. As the graph shows, even though the past couple of days have seen a drop of 8 or 9%, the market is still within what passes for normal in Shanghai. The local market, which fell yesterday by 1.1% because the banks all went backwards, went up today by 1.3% because the banks all went forwards, by as much as 3% and more, which makes no sense at all. The thing to keep in mind, though, is that the banks have corrected about 15% since April, and this has brought their share prices, on average, back to where they were almost 2 years ago. Other highlights today included an absolute spifflication of SEEK after it only managed to increase profit by 6%. Seven West shares went up despite a $1.9 billion loss caused by more than $2 billion of asset write-downs. Transfield went up a bit, even though industry super fund Hester said it was selling out because of concerns about what's going on in the immigration detention centres that Transfield operates. And Treasury Wine Estates jumped 13.4% after reporting a 22% lift in underlying earnings. And the dollar eased again, just a point or two. Finally, the Reserve Bank has published a paper on credit cards that shows that the banks sharply increased the money they're making on credit card interest during the GFC 7 years ago and then left it there. So much for competition. And that's finance.